discussion. Our topic is an overview of financial management. I am your discussant, Professor Rebecca McKilling. So our objective is to discuss about the form of business organization, creating value for investors, stockholder-manager conflicts, stockholder-debtholder conflicts, and balancing shareholder interests and society interests. Okay, let's begin. So finance within the organization. Look at our mm, organizational chart. The top is the board of directors, followed by the chief executive officer, which is the CEO. Under with the CEO are the chief operating officer or the COO and the chief financial officer, the CFO. So the Chief Operating Officer or the CEO handle the marketing, the production, the human resources, and other operating departments, while the CFO handles the accounting, treasury, credit, legal, capital budgeting, and investor relations. So what are the functions of the finance, no? So it depends upon the size of the firm. So if it's a small firm, the finance function is more on accounting unit. When it is a bigger firm, so the finance function is more on the separate finance unit. While for a large corporations, so the function is more on chief financial officer and treasurer and controller. So usually the treasurer is responsible for the firm's financial activities, including financial planning, the raising funds, making capital budgeting decisions, and managing the firm's working capital. It is also known as the chief financial manager. Okay? While the controller is in charge of the firm's accounting activities such as the corporate accounting, the tax management, financial accounting, and the cost accounting. And it may be called also as the chief accountant. So what are the major decisions in the finance function? So we have four major decisions in the finance function. We have the investing, the financing, the dividend, and the risk management decision. So in investing decision, it involves more on the provision of capital to proposals whose benefits are to be realized in the future. So usually investment in capital projects should provide expected returns in excess of what financial markets require. And on the other hand, for financing decision, it involves determination of the best capital structure. So here, you need to determine the best mix of debt, equity, and hybrid securities to employ. Okay? How about this dividend decision? It involves more on the allocation of cash to be distributed to shareholder. So excess cash can be distributed to stockholders directly through dividend. Okay? While for risk management, it involves determining which risk to accept, which to be neutralized, and which to transfer. The four key processes in risk management are identification, assessment, mitigation, and transference. Okay, now let's go to the forms of business organization. So we have here enumerated three forms of business organization. We have the sole proprietorship, the partnership, and the corporation. When we say sole proprietorship, it is an unincorporated business owned by an individual. So going into business as sole proprietor is easy because it is only owned by one individual. Okay, so merely if you begin your business operation, so that's the time you are making your sole small business or you are already engaged in sole proprietorship. How about partnership? Partnership, on the other hand, is a legal arrangement between two. So take note, two or more people who decide to do business together. So if ever they have already the consent and then they want to perform a partnership, so it will already form a partnership. So they can be established easily also, like the sole proprietorship, and of course, inexpensively. And they are not subject to corporate income tax. How about corporation? Corporation is a legal entity created by the state and is separate and distinct from its owners and managers. So take note, so partnership partnership is if there is consent between the two partners or two or more persons, partnership will be created. Okay, while corporation is you need to register it first to the Security and Exchange Commission, so it must be created first by the state or by the Republic of the Philippines, or you need to register your corporation name to the Security Exchange Commission, and then if they will give you the articles of incorporation, that's the time the corporation will be created. First, let us determine the advantage and disadvantages of the sole proprietorship. So what are the advantages of the sole proprietorship? We have easy and expensive to form because the owner is only one. So if the owner has the capital, you can already form your small business and you can already engage in the sole proprietorship. This is also subject to few government regulations, so that's one of the advantages of it, and subject to lower income taxes than the corporation because we have the progressive rates in the sole proprietorship, while for the corporation the tax rate is usually 30%, which is a bit higher to the sole proprietorship. How about the disadvantages? For the disadvantages, proprietors have unlimited personal liability for the business debts, which can result in losses that exceed the money they have invested in the company. So meaning the creditors can run over on their personal property if the small business goes to bankruptcy, because they have unlimited. When we say unlimited, so if they have still the personal property, like they have the car, they have the land, the house, still the business can, the creditors can run over on those personal properties. Okay, and then it's also difficult for proprietorship to obtain large sum of capital because the owner is only one, so it depends upon the capacity of the individual. The life of the business organized is limited because it's only up to the life of the individuals who created it. How about partnership? For partnership, one of the advantages is it is easy and inexpensive to form. Mere consent of two or more persons can already create a partnership. Still, this is not subject to corporate income tax, so lower income tax rate because it is subject for progressive rate, unlike the corporation, which is subject to a fixed rate, which is 30%. And then for the disadvantages, it has also an unlimited personal liability. So when we say unlimited personal liability, each partner is liable for the business debts, and if the partnership goes bankrupt, the remaining partners are personally liable, for making good on the unsatisfied claims. And then if the one partner is unable to meet his prorate liability, okay, the remaining partner will pay to the creditor. So meaning up to it's not only on the partnership asset, but the creditors can run through their personal properties. Okay, that's unlimited personal liability. Okay, on the other hand, for corporation, we have also listed some advantages and disadvantages. One advantages of the corporation is it has unlimited life. Okay, even the corporators, the stockholders died, the corporation will still live or will still establish, so it has unlimited life. And then it has also limited liability. The owners are not subject to losses beyond the amount they have invested in the business, so up to the capital of they have given or they have invested to the business. So the creditors, meaning the creditors, cannot claim over to their personal property. Okay. It is easier to transfer one ownership interest in a corporation than one interest in incorporated business. So it is easy because you just transfer your stock certificate to your heirs. So if the stockholders died, the the heirs, the one who can claim the inheritance to that particular stock, it is easy for them, no? Unlike for the partnership and the sole proprietor, if the owner died or the partner died, um, the partnership and the sole proprietorship must be dissolved. So it's not easy for them to transfer it automatically to their heirs. Okay. Next advantage is it is much easier for corporation to raise the capital necessary to operate large business because we have some stockholders. So just let the public buy the stock, so it can accumulate more capital than the sole proprietorship and the partnership. But for the disadvantages of it, it is highly, no? So it's very expensive, especially on the setup and the report filing, since you need to register it to the Security and Exchange Commission, and then this is subject for regulations, no, in the SEC, the BIR, and any regulatory bodies. So it is also subject for double taxation. When we say double taxation, the earnings of the corporation are taxed at the corporate level, and then when after-tax earnings are paid as dividends, those earnings are taxed again as personal income to the stockholders. So they can be subject to double taxation, unlike with partnership and sole proprietorship. Okay. As businessmen, what are the reasons on deciding on the form that you want to establish an organization, or you want to incorporate maybe your small business to a corporation, or your partnership to a corporation? So first is you must trade off the advantages of the incorporation against a possibly higher tax burden. So you must weigh it because you know that corporation has higher tax compared to partnership and sole proprietorship. However, bear in mind that the value of any business, other than a very small one, will probably be maximized if it is organized as a corporation for the following three reasons. First, it has limited liability. So when you say limited liability, it reduces the risk borne by the investors and other things held constant. The lower the firm's the risk, the higher its value. So meaning, if you venture in a corporation, if the business will go bankrupt, because there are some risks, we don't know in the future if you will bankrupt or you will be profitable. So if the business will go bankrupt and then you are in the corporation, you venture in the corporation, so up to only to your investment on the corporation. So meaning the creditors uh, cannot claim over your personal assets. A firm's value is dependent on its growth opportunity, which in turn are dependent on its ability to attract capital. Because corporation, it's easy for them to get capital, so many people venture in the corporation. Another reason that you need to consider when you want to incorporate a corporation is it can be transferred. Okay, unlike in the partnership or the sole proprietorship, the life of that organization is limited up to the life of the owner or partners. Since if somebody died or on that particular business organization, the business will be dissolved. But in the corporation, it will still be operated by the board of directors, okay, or the managers, or the managers. So meaning to say, if you have investment in the corporation, as much as possible, it is easier for you to transfer it to the another investor. So you can transfer it through sale, or you can transfer it to um, through donation, or through inheritance. Okay, so the value of that asset will also depends on its liquidity. So you can convert it to its cash value, or to its fair market value. So corporate investment is more liquid than a similar investment in proprietorship or partnership, and this too enhances the value of the corporation, especially if the corporation is traded in the stock market. Okay, now let us differentiate stock price and intrinsic value. When we say stock price, this is the market price of the stock that is in the stock exchange. Okay, the parties who are willing to buy that stock. When we say intrinsic value, it is the internal value, or it could be the par value of your stock. Okay, intrinsic value is a long run concept. On the other hand, the stock price is more on the short run. Okay, so if it is equilibrium, meaning there is no change, everything is constant, the stock price should equal to its true intrinsic value, but that is not the real situation. Okay, because the stock price will vary on the perception of the investors or on the buyer. Okay, there are some events that this stock price is greater than the true value of the firm, or the other way around. The intrinsic value is greater than the stock price. Okay, like what happened in our pandemic today. Okay, there are stocks in the stock exchange that the stock price is lower compared to the intrinsic value of the firm. Okay, as much as possible, the the managers, no, should avoid actions that will reduce the intrinsic value, especially on the decisions, no, when they want, of course, to increase the stock price in the short run, and then it reduces the intrinsic value of the corporation. Okay, so let's look on the determinants of the intrinsic value and the stock price. So we have these determinants: the managerial actions, the economic, the environment, the taxes, and the political climate will affect, no, the intrinsic value and the stock price of a certain corporation. The true investor's cash flow will also affect the true risk, the perceived investor cash flow, the perceived risk. So this will the perceived investor cash flow and the perceived risk will affect the stock market price, while the true investor cash flow and the true risk will affect the stock intrinsic value. And of course, when it is equilibrium, it must be equal, no, the intrinsic value and the stock price. Depending on the investor, whether they will choose the intrinsic value or the market value, they must weigh, the advantage and the disadvantage of it before they will venture or they will buy on that particular stock. Okay, usually there are persons that who like to buy based on the market price, while others, if they are investing in the long run, they choose the stock intrinsic value. But for buying and selling of the stocks in marketable securities in the short run, usually investors choose, the market price over the stock intrinsic value. So again, it depends upon the appetite, the risk appetite of the investors. Stockholder-Manager Conflicts. Managers are naturally inclined to act in their own best interests, which are not always the same as the interests of the stockholders. Remember, the managers are the one who operate the corporation, who operate the business. The stockholders are the one who invest, who buy some of the stocks of the corporation. There are cases that managers are also the stockholders, but not all stockholders are managers on a certain corporation. So basically, there will be conflict between the two. So what are that situation? Okay, we have the following factors affecting managerial behavior. First is managerial compensation packages. There are some corporations that the managerial compensation is too high. Okay, and there are also managerial compensation which is too low. Okay, so if that is the case, of course, when it comes to the meetings, the stockholders meeting, there would be conflict between the stockholder and the manager, because if the compensation is too high, um, the dividends of the stockholder may may be short, no? May be shorted or maybe lower compared to what they expect. Okay. Second is if there is direct intervention by the shareholders. Okay. So if there are intervention, especially on the decision making and then on the stockholders meeting, okay, there would be conflict, no? Especially if it is not on the side of the manager, no? Because the manager has some bias or the stockholder has some bias on that particular decision. So basically, they will be conflict. There would be conflict with each other. Third is there is a threat of filing. Okay, if that case, the manager is threatened, no, uh, he or she will be fired on that corporation. So uh, the operation, since he or she will be the one who is in charge of the operation, the affairs of the corporation, basically, we don't know what would be his decision. No, maybe he will not run the corporation in an orderly manner, or he may engage in other fraudulent activity just to compensate his losses because there is already a threat to his position. Second, as fourth is the threat of takeover. Again, the same with the third. No? If there are threat, okay, and then the manager is the one who is um, directly operating the corporation, he or she has the opportunity to put some any what do you call fraudulent activity just to make it just to compensate, no, compensate his fear on his threat, no, on firing and takeover of his position. Next, stockholder-debtholder conflicts. Stockholders are more likely to prefer riskier projects because they receive more of the upside if the project succeeds. By contrast, the bondholders or the debt holders receive fixed payments and are more interested in limiting risk. So there are conflict because the debt holder, the bondholder, usually they don't like risk. So they, as much as possible, the corporation must be liquid, must be solvent. Okay, so small risk. But for the stockholder, it depends upon their appetite. If they are uh, aggressive, no, on risk, so they receive more riskier projects because they invest their money there. Okay, so bondholders are very particularly concerned, no, about the use of additional debt. And then bondholders attempt to protect themselves by including covenants in bond agreements that limit the use of additional debt and constrain manager actions. Okay, so that if that is the case, no, and take note, on the part of the debt holders or on the bond holders, they know that this corporation has limited liability. So they can only claim up to the extent of the asset of the corporation. So they must be no, kanang protect themselves, no, from that risk na if ever the corporation will go bankrupt, they can only claim up to the extent of the asset of the corporation. They cannot claim against the personal asset of the incorporators or on the stockholders. Okay, so they must be aware of it, no, nga they must put some covenants, um, they must limit, no, additional debt, because if too much debt on the part of the corporation and then debt or utang, there is interest there. Okay, and if there are interest and and the cash on the part of the corporation is very low, no, so hindi na liquid, hindi na solvent, meaning the corporation cannot pay already their obligation in due terms, or the short term and the long term obligation. So if that case, merong risk, no, nga mabankrupt si corporation. Kaya aware talaga si bondholder na if as much as possible, limit the risk. Okay? So, balancing shareholders' interests and society interests. The primary financial goal of management is shareholder wealth maximization, which translates to maximizing the stock price. Okay? So, value of any asset is present value of cash flow stream to owners. Okay, that's shareholder wealth maximization. Okay, so the present value must be, of course, in favor to the owners. Most significant decisions are evaluated in terms of their financial consequences. Kaya they have some kind of meeting, stockholders meeting, board directors meeting, before they will go or they will implement their decision. So it must be first be known to their stockholders, especially if it's a big decision like merger, acquisition, venturing on a new business. So that's a major decision. The stockholders must know on it. Okay. The stock price change over time as conditions change and as investors obtain new information about a company's prospect. So in the stock market, the stock price is volatile. There are cases that is very volatile. It will change over time. It will not, there are also cases that it will not change, okay, depending on the perception of the market. So if there are new information about the company's project or prospect, okay, and it is new, it was broadcast, no, locally or national, okay, and it will affect, no, the price of that particular corporation. So the shareholder or the management must balance based on the shareholder interest and, of course, the society interest. Managers recognize that being socially responsible is not inconsistent with maximizing shareholder value. Again, the goal of the management, of course, is to maximize the wealth of the shareholder. But there are situations that the society interest must also be, tatanggapin natin yung interest ng society, because it will really affect the stock market or the stock price of the market price of your stock. Okay, so it's not really consistent. Although you are socially responsible towards the society, you do some projects towards the society, okay, but it's not really mean that you are maximizing the shareholders value. So when you want to maximize the shareholders value, you focus more on the operational side of the company, gaining more profits, okay, maximizing profits, minimizing expenses, minimizing losses, just to maximize your capital. Okay, but there are situations that you need also to consider the society. Let's say, for example, in a manufacturing business. Okay, so in a manufacturing business, there are situations that you are already damaging, the environment, you are already damaging the health of the society. It's very hazardous already, especially if you are manufacturing a product that is very harmful to the society. So you need to manage it, no? Okay, not always maximize the shareholder value. You need to balance the society interest and the shareholders interest. Next, financing with international bonds. There are situations that, especially if it's a very large company or large corporation, they venture on international bonds. So international bonds are debt securities issued by foreign companies or governments and sold domestically. So how it works? Example, Foreign companies or governments may issue bonds that are securitized and sold to domestic investors in the form of international bonds. These bonds are typically denominated and pay interest in the currency of the issuing country. Therefore, the value of the bonds in the domestic currency will fluctuate depending on the economic condition and exchange rates between the domestic country and foreign country. So when we invest in international bonds, securities, we make utang, we buy or bonds, and okay, from that from foreign countries. So take note, it's different money. No, it's different currency. So we have Philippine peso and other currency. Okay, and we know that forex, the currency of that particular company also fluctuate. No, especially if it is that is already in an international trade, no? So especially in the forex market. So we need also to consider the value, the fluctuating value of that particular currency, okay, when we want to finance with the international bonds, okay? So why it really matters? International bonds can be used to hedge against currency and country-specific risks. For example, American invested international bonds have reaped the gains from falling US dollar in recent years as it has made interest payments from foreign bonds worth more in dollar terms. Since there are risks of fluctuation of the currency, most of the domestic corporations go for hedging against the currency just to compensate the losses of the fluctuation of the currency. Okay? So, ano lang, they balance it, no? Kasi you will also pay interest on that particular bonds. So take note, aside from payment of your debts on international bonds, you have also interest, okay? And then if you will not look on the risk of fluctuation of that currency and you will not go for hedging your currency, the it will be maglobo yan, no? Maglobo yung utang mo, no? Your principal and your interest. Kaya meron tayong consideration on international bonds. So we go for hedging, we go for forex, just to compensate the losses against your gains, no? Para lang mabalance, no, the loss and the gains. Okay?